Gold is falling. Yeah, the same gold that's supposed to protect you during chaos is actually dropping right when the world feels the most uncertain. Now that doesn't make sense, right? Because we've always been told when inflation rises, when markets get shaky, when fear takes over, gold should go up. But right now, it's doing the exact opposite. And that's where things get interesting because investors are completely split. One side is saying, this is it. Gold is losing its relevance. It's not the safe haven it used to be, while the other side is quietly buying. Seeing this as one of the biggest opportunities in years. So the real question is, who's right? Is this the beginning of the end for gold? Or are we looking at a massive discount that most people are too scared to touch? In this video, we're breaking down both sides, the bearish case and the bullish case, so you can actually understand what's happening and make a smarter decision instead of just guessing. Let's start with the uncomfortable side first, because there are real reasons why gold has been struggling, and ignoring them would be a mistake. The biggest one? The strength of the US dollar. When the dollar gets stronger, gold usually goes down. Why? Because gold is priced in dollars. So when the dollar rises, gold becomes more expensive for other countries, which reduces demand. And right now, the dollar has been extremely strong. But that's just one piece. The bigger factor is interest rates. When central banks raise interest rates, something important happens. Bonds start offering better returns. And here's the problem for gold. Gold doesn't pay you anything. No interest, no dividends, nothing. So when investors can suddenly get 4%, 5%, even higher returns from safe government bonds, gold starts to look a lot less attractive. This is what we call opportunity cost. Why hold gold when you can earn guaranteed returns elsewhere? And that's exactly what's been happening. Money has been flowing out of gold and into bonds. On top of that, rising bond yields make things even worse because now investors are not just getting returns, they're getting better returns than before. So capital shifts quietly but powerfully. And when large institutions move money like this, prices follow. So from a bearish perspective, the argument is pretty simple. Strong dollar plus high interest rates plus attractive bond yields equals pressure on gold. And until those conditions change, gold could continue to struggle. Now let's flip the perspective, because while the short term looks weak, the long-term story might be completely different. Let's start with inflation. Even though inflation has cooled down a bit, the bigger picture hasn't changed. Governments are still printing money. Debt levels are still rising. And historically, that leads to currency devaluation over time. And when currencies lose value, gold tends to shine. Because gold isn't just an asset, it's a store of value. Now here's something most people miss. Gold doesn't move in straight lines. It moves in cycles. If you look at history, gold often goes through long periods of consolidation, even declines, before making major moves upward. And during those quiet periods, that's usually when smart investors accumulate, not when everyone is talking about it, not when it's already going up, but when it feels boring or even disappointing. There's also the psychological factor. Right now, sentiment around gold is mixed, even slightly negative. And in markets, that's important because fear and uncertainty often create mispricing. People sell not because something is fundamentally broken, but because they're reacting emotionally, and that creates opportunity. So the bullish argument is this: short-term pressure, but long-term fundamentals still intact. And if that's true, then what we're seeing right now might not be a collapse. It might be a discount. So instead of picking a side emotionally, smart investors do something different. They watch key signals. First, interest rates. If rates start to stabilize or even decline, that removes one of the biggest pressures on gold. Second, the strength of the dollar. If the dollar weakens, gold gets breathing room. Third, inflation expectations. Not just current inflation, but where people think inflation is going. Because markets move on expectations, not just reality. But here's the most important mindset shift. Smart investors don't try to perfectly time the bottom, because that's almost impossible. Instead, they focus on positioning. They ask, at these levels, does this make sense long-term? And if the answer is yes, they build slowly, not all at once, not emotionally, but strategically. Because in investing, patience often beats precision. So, is this the end of gold or the best buying opportunity? The truth is, it depends on your perspective. If you're looking short-term, the pressure is real. But if you're thinking long-term, the story might be far from over. And that's the difference between reacting and investing. Now I'm curious, which side are you on? Do you think gold is losing its shine or just getting started? Let me know in the comments. And if you want more breakdowns like this, simple, clear, and actually useful, make sure to subscribe. Because smart investing starts with understanding what others overlook.